Hey Josh, what's going on, man? Thanks for taking out the time today and chat with us. Before we get into it, I know we were chatting for a minute. You and I are on both, different sides of the United States. Me in California, you in New York, and we were chatting just a little bit about business. Before we jump into what you're doing, can you kind of give a little insight on who you are, and then also kind of what you did prior to jumping into real estate, and then we'll go into your real estate experience?
Sure. So my name's Josh Eitingon. Prior to real estate, and I've been in real estate, I started right around when you did. I started, I think, in 2012. It was
Okay.
2012. Prior to that, I was actually in software. I worked as a project manager for a software market research company in the city. But pretty early in my career, I transitioned over to real estate, first as an employee, and then gradually left and started my own business after that. It's just real estate's fun. I was always drawn to it. Just the simplicity behind it. I think the number side of it, hey, someone paying down your mortgage for you, always made like easy economic sense for me. So there was always something in the back of my mind pulling me into it and away from what I was doing at the time.
Yeah, for sure. So going back to 2012, I mean, obviously, no one really knew, when we were going to come out of what we were in 2012. So it's a dicey time. We were rolling into 2013, and then that's when there was a lot more confidence in the market. So can you talk about, why in 2012 you jumped into it, like specifics, and then what type of real estate at that point did you jump into?
Sure. So I actually started in multifamily. My very first deal I did was a 20-unit short sale property in the Midwest in Cincinnati. I was connected through a friend to a property manager that was out there that knew a head of a bank that was in this short sale situation with a guy, and he said, "Hey, if you want, we could try to plug you in here." And maybe I was young enough and dumb enough at the time to just say, "Okay." And a terrible story for me to tell you and your listeners, but that's the reality of how I started on that first project. It was $175,000, was a complete disaster in terms of like what it looked like. It was occupied by 4 tenants, no one paying. But I was attracted to the basis. It just, on paper, I think pushing myself in every direction of what could go wrong, I felt like it made sense, felt like the downside was relatively limited, and that was ultimately my leap, or at least how I rationalized in my mind at the time.
Yeah, that's I mean, that's something to jump into and really like cut your teeth on. And I know a lot of people are just like, they do pretty small deals and then, they kind of are just like whatever afterwards and walk away from it. After that one deal and going through, sounds like some ups and downs on it. What kind of propelled you to continue doing them and doing, getting into, really knowing multifamily?
So at that point, as I was dealing with some challenges and around it, it ended up being a really successful deal, maybe even with some errors by me along the way. I think there's not too much that you're buying in 2012 that did not become successful unless you really screwed something up operationally. But at that point, I knew I wanted to get into real estate. So I just began looking for a job basically on the real estate side. I actually cut my salary probably 40% to work as an analyst first for a investment group here in New York that bought mostly Southeast garden style multifamily.
Okay.
So that I'd say more than anything, that's how I really learned from a group that was doing it at a much larger, more sophisticated level than me. And then after 4 or 5 years with them, then I peeled off on my own and really became an active investor and started DXE, my company.
Nice. So you're working for them, and then it's all the stuff's in New York, all your deals?
No, everything in the Southeast. So mostly, I shouldn't say everything. Most in the Southeast: North Carolina, South Carolina, Georgia. We've owned in Florida in the past, but mostly those 3 states.
Okay. And why, made you gravitate towards those states versus New York? Granted, obviously, I know price point and stuff like that in New York may be a little bit different, but maybe you can speak to, the upper side of New York and those, those parts that may be a little bit less expensive versus going down to out of state. So tell me about a couple of those.
So it was a few reasons. One, us going out of state was driven by just the story behind it. So I think trends just demographically, people are leaving New York, headed south, whether it's cost of living, affordability, quality of life, even job opportunities are drawing people from New York City and surrounding areas south. So I think it's an easy story to tell. But in reality, what really took us there was that I was, after being an analyst, I became one of two acquisitions guys sort of leading a small team. And I was the face sort of interacting with these brokers, property managers down there. So it was an easy step for me to take, basically leveraging those relationships to start my own business and build around that existing team where they've already worked with me and seen us perform. So while it's not the most sophisticated reason, there was a lot of safety associated with us jumping into the South for that reason. Price point, obviously, that like a $10 million deal in a New York, even surrounding metro area, is nothing like what you could get in the South. Yeah. And that's not to say you make more or less money, but it's far more scalable in the South, because anything we're buying for $10 million in the South, we could staff full-time employees. Whereas, that 15-unit deal on the Upper East Side in Manhattan, you have to manage that yourself, and you're probably underwriting it with, insurance, utilities, and a 3% vacancy factor, and buying that cap rate. So I think there was a little more opportunity, particularly at the time, and we just saw the ability to scale better and just be more efficient in the South, even though we're not walking distance from any of our properties.
Yeah. So you're building this business out of state, and you've had the relationships down there. There's a lot of people that run into, buying stuff out of state and they just don't feel comfortable. Outside of, having those contacts, can you talk a little bit about how you had confidence in buying something out of state versus, I gotta be at the property, at least every Friday to feel comfortable about buying this property. Talk to me about that, how you were able to have that confidence outside of the relationships.
Yeah, that's a great question. And all of your property I know it's mostly Orange County surrounding area. Is that the case, that you could drive to everything basically within, an hour?
Yeah, one's like 2 hours away, but outside of that, everything's, I'm not driving to that every single day, and I feel comfortable going to, the contractor and saying like, hey, just handle this, and take care of it. So I guess, going back to leaning on those relationships, that's what gives me a little comfort.
Right. No, and that's the exact same thing. I think it's twofold. One is we have to employ third-party management in every market that we're in. At this point, it's really one, maybe two property management companies that we work with, and both of them have really meaningful scale and checks and balances and full back offices. Like our property manager in Atlanta manages over 20,000 units just in Atlanta. And we do have a full-time team on any property, meaning at least two full-time employees on any property that we own. So that's their, they own those properties basically, and they are completely responsible for them. They're not bouncing between 7 different ones. So it's a very direct relationships in terms of, hey, it's not working well. We know exactly where we're finger pointing. And if we need to adjust, we can. But to answer your question more directly, it does take some getting used to. I don't think one reason we had to elevate the deal size was because of just that. You're just not going to get the same efficiencies. At least we aren't, or we never solved the formula, at least for running those, 15, 20, 25 unit deals, because you have a manager that's jumping between, 7 different properties in a day, a leasing person that has their hands full. So we couldn't figure out that formula. So we had to do larger deals where we could put a little bit more ownership on the people that were really running our business day to day.
Mm. Yeah. So that gives good, context, especially like buying stuff, out of state and being able to do that. And then also scalability is, everybody talks about economies of scale for multifamily because, they can't really scale if they have 2 to 3 houses, but if they have, 2 to 3, 50 unit apartment complexes, it's easier because you're going 3 spots for, 50 doors each. So that really tailors to, being able to buy it and be more efficient out of state, right? Since you've been running the company and being able to be efficient in what you guys are buying, what's that end consumer, what's that end product look like for you guys? What are you guys buying? What's your bread and butter?
So it has definitely changed over the years. We started in what I would call like the certainly C-class workforce space, even affordable space. And I think that's where we sort of skinned our knees and started off in this business. And that's the wrong expression, but you get the idea.
Yeah.
We certainly bought the rougher deals where we could put a bunch of money into them, drive rents a bit, and jump out of it. We have since really shifted to quality of location as our driving factor that we're looking at. It's like the what everyone says about real estate: location, location, location.
Yeah.
It's completely true. No one's learning anything on this from that sentence, but
yeah.
We're really targeting a step up in underlying submarket. I mean, any of the cities we're in are sizable enough, and there's a diversity of industries. So we want to be at least in a 500,000 person MSA. We want to see at least 3 different industries that are driving jobs for that area. But more specifically in the submarket, we do want to see, relatively strong schools. We want to see good, meaning like, we want to see quality retail around there. We want to see higher home prices, just because I think that, we know prices are high. I don't think anyone could argue that. At some point, something's going to happen somewhere. And we really are believers that your ultimate safety net is just the underlying location that you're investing in. We like right now 2 different profiles of deals. One, newer construction that may have leased up through COVID, or maybe it's not. It's done by a developer that may not be the most efficient operator, where we could come in and maybe make some small improvements, get them out, and risk adjusted sort of hit a compelling yield versus the more true value add stuff. And the other side, we still like the value add stuff that's well located. Yeah. So we're doing a deal right now, actually, that's been owned by the same group for 24 years. Actually, the leasing person has literally been there for 24 years.
Oh, really?
Yeah.
That's pretty nuts.
Glad we came across that. But and it's a lot of low hanging fruit where we could come in. They never really renovated. We'll do a full renovation, interior and exterior, and really drive rents and manage that on like a 3 to 5 year business plan. So that's like our focus now. It hasn't shifted that much from the past, but we see we're always chasing the long term owner story that everyone is chasing, and. But I think the newer development side, I think, is something where we see just a little bit of I don't want to call it an edge, but a little bit of like opportunity where we can't buy $50 million deals right now. But I do think a $20 million new development, you're certainly not getting institutional capital after it. And then the other versions of us that are syndicating equity from just private funds or private individuals, they typically don't have the time horizons that you need to be able to buy this newer product.
Yeah.
So we think it's like a compelling niche to be able to focus on a little bit right now.
Yeah. No, that's good. And especially like the biggest thing for you guys is obviously knowing what that avatar is that you're looking for. And obviously you guys have been able to niche that down, and especially the areas too. What are you seeing right now, especially in those areas that you're purchasing? What has changed? And then I'm going to go into like, how are you guys pulling that data that you're looking, at those properties, before you're purchasing? So what are you guys seeing in the market? Still pretty pretty stable, kind of going back to what you said, like at some point something's going to happen, but still pretty stable. Nothing that's really changed so much.
From when? From like a year ago? From 3 years?
Yeah, let's go from this time last year, and then we can talk about the last 3 years.
Yeah. So from this time last year, there's certainly it's way more competitive because I think a lot of people, in light of COVID, were pressing pause and cautious. Lenders had increased reserves, so it just made deals a little more equity heavy to be able to step into them.
Mm-hmm.
And you had owners and sellers that I think the general feeling was, hey, this is a relatively temporary impact. Let's just be cautious and wait. So you had limited supply, certainly less transactions. And then as that year continued, you saw all of the money, especially like me in the New York here, that's just been frozen. Transactional volumes like been cut, I think in some cases like 80-90% the prior year, shifting money to the Southeast because they like it for the same reasons we do. They like the ability to get on a plane and be back in the same day potentially.
Yeah.
So I mean, now it is super competitive. We've offered on deals with 40 plus offers and like $500,000 hard day one that we really are not interested in competing on.
Yeah, that's insane.
for like beat up 70s product deals.
Yeah,
it's like
that's insane.
So it's crazy. It's really tough. We for a full year, we last closed on a deal before the ones that we're working on right now in December. We must have offered on 60 deals from then until now, and finally, we do have these new projects that we're working on, but it was through broker relationship off market, which means people were certainly seeing it, but at least a smaller pool that we were competing against.
Yeah, that's good to hear. I mean, dude, I've heard that from numerous people that are jumping into. I mean, residential is completely different, but with commercial multifamily, I've heard the same thing where it's just, insane. Money's hard within, 2 days, and almost really, some inspections aren't even added in. Just kind of going all in and full tilt on making sure that they get that deal covered. And sometimes people don't have the liability that they want to throw out there to make it happen. So, and I completely get that, especially, unless you know that market and like you've lived in that market for like that lady that you said that had worked there for, property manager as 24 years. Like if it was her and she was buying these deals, I'd be like, yeah, good. But yeah, it just seems like people are kind of throwing all the cares of the wind and, hoping, making sure something sticks. What have you seen in the last 3 years on, real estate investments, especially the ones that you guys are going after? Any changes? I mean, granted, let's take out last year because you just talked about it, but the 2 years prior leading into last year. Yeah.
So, rents have definitely gone up. You could have not spent $1 and pushed rents really in any of the markets that we're in. And I would say cap rates have only compressed from there. I think that's the reality. And I don't think it's not necessarily not founded. Like you've seen interest rates come down to historic lows. You've seen demand not disappear. It's difficult for me to not touch on COVID, but in light of COVID, you saw very little multifamily distress.
Yeah.
So it sort of proved itself. I don't want to say proved itself, but it weathered that storm, showed a resilience. We are, I will say, cautious apartment buyers anywhere in the cycle, and every year we're going to buy apartment deals. But there's going to need to be some sort of a meaningful reset, I think, to get a lot of capital that's active on the sideline.
Yeah, for sure.
For you in like Orange County, which probably has similarities to some of the, New York, at least submarket markets. Are you seeing the same, or is it because it's California, it's a little bit more muted? Where things, I think, came to as much of a halt as it did in New York.
So are you talking about last year with COVID, like the slowdown, or are you talking about the expansion that we've seen in the last 6 to 8 months?
Well, I guess you answered it right there.
So So I'll just go through, I mean, for you, since we're so polar opposites just on, the other side of the United States, for us, it was, the first 2 months of COVID, I'm going to say March to almost all of April, everything kind of stalled out, and it was a complete standstill on residential. And granted, that kind of tailors into the economy as a whole. And then from there, once we finished up, and when I say finished up, like NAR, National Association of Realtors, kind of figured out like, okay, hey, well, we can still do showings. It's got to be masked, and we got to sign this document saying that everybody knows about COVID and stuff like that prior to going into the home. Once that happened, then from there, everything was back full charging. So I would say end of April last year, it was a very, very solid market, at least for me, fortunately, and our team going forward from the end of April last year until now, and it's still consistent. I mean, granted, the tail end of last year, the last quarter of last year, it was even stronger than, midsummer, because people were still kind of getting their bearings, but it has moved strongly into this year as well.
Yeah, I mean, it seems to be almost independent of market. That seems to be the story in a lot of cases. I mean, I don't know. It's not an easy time to be like a first-time home buyer. I feel bad for everyone that's trying to buy a house and start their family now.
Oh yeah, just I mean, anything that's less than about 15% down, everybody's just getting blown out. And they just continue to get beat out by people that have 15-20% down. They can meet that appraisal gap. So that's the biggest thing, is what we're facing, and what we've seen. So so since you've been doing real estate investing since 2012, going back to 2012 till now, if you could pick out two things that you said like, hey, I shouldn't have done this, I should have done that throughout the course of your investing, life and being in real estate, what were those two things to kind of help out someone that's maybe jumping in just to real estate in general now, so they can kind of stay away from those things?
Well, hindsight's funny. There's plenty of deals that I should have held, that I flipped out of, and thought I was selling, like we said. I think I sold in 2018, and I was like, oh, we're at the peak. This is great. I'm going to make all this money. And sure enough, if I held the deal 2 more years, it probably went up in value, 35% for doing nothing.
Yeah.
So
it's crazy. Yeah.
There's plenty of those where I can kick myself. And it's tough. I mean, especially you're starting a business or getting into real estate, and you have an opportunity to show like short-term success, build a track record. I would never steer anyone away from, building up that resume. But, if you're an individual investor that could be nice and patient on some of these deals, I'm a believer in long-term quality real estate. It goes up. It's proven itself time and time again. So if you could be patient, I think be patient in a lot of cases. And then 2, I think really getting my arms around managing the construction process from afar. My background was not construction. My partner, actually, he comes from a construction and development background, so
That's good.
runs that side in a lot of ways. But it's difficult when you're stepping in without just some level of know-how outside of plugging in numbers as an analyst. It's different than the reality. So I think beginning and continuing to educate yourself on that side is certainly helpful.
Yeah, for sure. So he does construction development side. What do you do? What's your role, especially in the business? Are you relationships, and then also, building that syndication, that the funds to make sure that you guys can purchase and move forward with that property?
Yes. So I am call it the acquisitions guy still,
Okay.
Which is what I did in my past role. I tend to lead the legal side of the business, and the transactional side, basically getting us from LOI acceptance through closing. And then at that point, my partner tends to drive anything construction management driven, even most of the day-to-day asset management. But I certainly can't not get involved on some of the operational things. And I like to really dive in on the leasing side and marketing and what we're doing there, just to ensure that the machine's still turning. And we both take a pretty active role once a deal does hit and we're syndicating money or anything from an investor relations side. Is both of us all hands on deck. We have a bookkeeper. We have another person. We have a part-time person working with us administratively also. But we run pretty lean and mean, which we plan to do at least for another few years, because it sort of works.
Yeah, no, that's good. When you're able to run, that small of a team, you can be very fluid, and especially when problems come up versus, something that's a, big hedge fund or something like that, you're running against, you guys can easily be nimble and move around and do some things that, they can't, and vice versa. So, which is huge, right?
We, this morning we spoke to someone, my partner is sort of an extended connection. He was previously running or co-running $1 billion fund. They invested when he was there 2 years ago in 75 deals in 1 year on $1 billion fund. And he's like, we were at a point where needing to hit our hurdles and wanting to hit our hurdles, we were selling the best deals and keeping the bad ones just from a cash flow perspective. He's like, it was entirely counterintuitive. So like there is something to be said for like finding that formula. Not to say we can never compete with Blackstone or whatever. But, there's a lot of I think stuff that large funds are forced to do that may not necessarily be the right thing to do because of the money that they have.
I mean, and then you get the situation where, especially those where, they can't move. I mean, they can move on stuff quick, but they can't move on it as quick as you, because you guys can, and they don't know the area. They have, someone that's a deal analyzer, and they're not even from, North Carolina. They're looking at a deal that, you guys know the nitty gritty of it and the granular situation, versus, someone else that works there is just analyzing the deal, and they only know it from, 20 to 30,000 feet above. You know what I mean?
Yep. No, exactly. There's a lot of, as we know, there's a lot of opportunity in real estate to just know what you know and be really successful sort of at that formula.
Yeah. So what do you guys, if I was to come sit down with your team and you, what are you guys looking to do in the next, 1 to 2 years on acquisition side? Are you guys looking, a deal a quarter? Are you guys looking, 4 deals a quarter? What's kind of what your mentality is and how you guys have structured that for the next couple of years?
We want to do 2, at most 3 deals in a year.
Okay.
So 2 deals this year. We're going to end up closing like $35 million worth of real estate across those 2 deals. Okay. And next year we hope that number's 50. But that's the formula that I have no interest in doing 8 or 9 deals in a year. I know for a fact that the 30-unit deal takes as much, if not more time than the 200-unit deal. And it's just, I think there's a lot less safety from an efficiency and management perspective. So, what we are constantly working towards is finding the right equity partners that are going to support that vision. But thus far, it's been mostly friends and family. We've probably raised $20 million to date from I'll say very extended. I don't have but we've been just doing it very organically from that first $175,000 deal to now the most recent deal will be a $25 million closing, and just trying to gradually build up and be in a space that's as efficient as possible.
What have you found, especially niching down on properties or an area that's the hardest for you guys? Especially you get that shiny object syndrome where you're going after something that's not even in your market, but the numbers make sense. What have you found, outside of that? What's the hardest to kind of look at and say like, hey, this is where we're going to be. This is where we're going to be for the next couple of years, and this is where we're only going to find deals.
It's difficult. It's difficult. We are always chasing a story. I think it's probably, it's very similar to your business, that we're chasing some real motivation, chasing something where we can get some perceived value day one, especially with the number of deals that we intend to do. We want to make sure they're good deals. So we spend a lot of time just flying around and chasing a story that may be a quote unquote off market deal, but maybe the seller's not ready and we spent all this time all for nothing, or we thought this was off market, but actually there's 30 people looking at it. So we just wasted a trip out there to be bid against 17 funds that have way more money and flexibility than we do.
Yeah.
So I think that it's a time challenge, and it's difficult for us. Other than I think at this point we've just committed to that grind and that hustle, basically, to find the opportunities that some will present themselves and vet out and be real, and others will just be kicking ourselves on the flight home. So,
yeah. No, I agreed. So going back to what I was going to ask is, so for data, what are you guys usually using online to search out an area for, what you're looking for on data on, what's the current employment look like? What's the vacancies look like for those tangibilities to look at deals outside of, your area that you grew up in? What are you guys using?
We use CoStar.
Okay.
I don't know. I think generally that data is pretty good. I mean, any of the markets that we are in, we intend to stay in, and likely there's not any, call it, blips that are going to throw us from one market to the other.
Yeah.
It's mostly CoStar. It's broker reports that are published that we'll often cite, and they're usually referencing like Reese or Yardi Matrix in some of theirs. And then, I mean, we'll look at U.S. Census trends, but I'm trying to think what else. I mean, some submarket stuff. We use ESRI.
Oh, yeah.
So I like ESRI for different pockets, and it gives like some quick stats that I otherwise don't really get.
I grew up in the town where they started it. Yeah, where Dangermond started it. Yeah, so yeah, it's weird. People call it ESRI, but I grew up. I got a bunch of buddies that I went to high school with that started working there, and they call it ESRI. And when I heard someone call, some people were like ESRI, I'm like, yeah, I don't even know where that is. Like, that's in Redlands, and they're like, yeah, and I'm like, oh, and then they were like, I don't know, and then I saw it, I was like, oh, I know what that is.
Got it. So you're saying I sound like an idiot?
No. Like, yeah, I was like, I don't even know what that is. But I think that just evolved over time.
Yeah.
So that's funny.
Otherwise, I those are really our go-tos. I mean, we're always just any of the markets we're in, we're subscribed to all their local newspaper. We're trying to just monitor any job announcements. Like we're doing a deal down in Savannah. Amazon just announced I think it's like a 600,000 square foot new distribution center and 1,000 new employees. So that's stuff that we're always looking out for. But a lot of it, I hate to say it, has become somewhat anecdotal in what we're chasing. Augusta, there's a big cybersecurity story in Augusta. We had been reading about it. We read about it on Wall Street Journal article, and then sure enough, started seeing some deals there and dug in from that perspective. And it ended up being a market, frankly, on the smaller side of the markets that we're in, where we got comfortable investing. And sure enough, it's probably going to be one of our best deals we've done in the last couple of years because we were pointed to it from a very anecdotal article that had very little to do about rentals or true market information.
Nice. Do you, being out there, I mean, excluding last year, when you're building those relationships, kind of going back to what we talked about, having those relationships in different markets, how are you how are you cultivating those after you meet the person and, you want to develop that relationship deeper and to maybe invest with, or, have them as your full-time, let's just say full-time contractor. Once you left the area to go back home to New York, how were you able to cultivate those, just for people that are looking to, build a solid structure around an area they want to ultimately invest in, they don't live in?
Mm-hmm. It's tough. It's tough. If you're really starting, the answer is probably the best thing you could do is do a deal and start engaging whether contractors and trying it out and getting them some business. And then you'll get people some goodwill and people working, call it for you or for free for you, to really be able to take advantage of some of those relationships.
Yeah.
You get the deal done in the first place, maybe is the question, and it's time. I think you can't do it all from afar from your seat. You have to go meet people, buy a coffee, buy a beer for them, let them know that you're real. And it's the only way, and it doesn't happen overnight. It's a gradual process. So I think the best thing you could do if you're not going to be in the market that you live in, is spend a lot of time on the ground there and really commit to it. I think a lot of people maybe believe that you could do it from home and make millions of dollars in your seat, but it's not the reality, and relationships take time.
Yeah, for sure. No, I agree. It's so, it's so funny, especially when you get into anything. It doesn't matter about real estate or not. When you get into, let's just say, business, and you're new to it, you feel like, that deal, or, the transaction, or, making that commission, whatever it may be, in whatever field you're in, you feel like that's going to be, as soon as I meet Josh, we hit it off because we had, a cup of coffee, and then all of a sudden he's going to, transact with me, or he's going to, get me a deal, or, ultimately I'm going to get a commission out of him. And that's not the case, because that's not how any other, especially, being younger and stuff like that. That's how you feel like relationships should go, and you want them to go that way, but it's not, because it takes so long to build that confidence in you, that likability, and that trust.
Yeah, totally agree. I mean, one of my strategies as I started, just being younger, was sort of to focus on like the Cushman guys that are younger, that were just getting into business, that, were in the 30s, like myself at the time, and we're just sort of growing up in this field, and with basically the process, hey, I'm going to do this a long time. You too. Let's hope to make each other a lot of money.
Yeah.
And I think it's easier also. You could talk about, just had kids or whatever it may be. So you're sort of growing up together from afar, but it's a time commitment. Like, I mean, some of your favorite clients, you could probably list them out on, a hand, and it's probably just that, a long-term relationship.
Yeah, for sure. I mean, it's, and it's a lot of people. I know some people are like, well, I don't want to do a ton of business with friends and stuff like that, or family. And you could probably speak to this, especially, raising money through friends and family. But it really depends on, expectations on what you've set forth, once you develop, whatever you're ultimately going to be doing, and make sure that those expectations are met. And then also, provided a good outline when you start talking to them about whatever you're doing. That's huge.
Yeah, it's a sensitive thing. Every family's different, so I certainly won't tell people to raise money from family if you're not comfortable with it. But it was a little bit of an internal struggle. I think that for me, I just really wanted it and was willing to do anything possible to do it, and was willing to perhaps burden that risk, whatever it may have been. I don't know if that's the right answer or not, but that was the reality for me, at least, getting started through that path.
Sometimes it's, it drums up your why, and then ultimately, some people feel more comfortable than others on asking that, of family. And obviously, like you said, you won't, direct people on doing yes or no, doing it or not. But, well, that's definitely helpful, especially for people that are trying to navigate those relationships and how quickly they can evolve versus, how ultimately they revolve. So, okay, we'll transition, Josh, to the last couple of questions before we get you out of here. One, what do you what are you guys using in business today? I mean, outside of the data stuff that we talked about that has really helped you grow the business, like an online tool or a resource online or an app that's helped you in the business?
We use Airtable. I don't know if have you come across Airtable?
No.
So it's sort of like, I'm trying to describe it. It's basically Excel tables that are extremely easily shareable. I would say it's like a better version of Google Sheets.
Okay.
Where you can really personalize it. You could assign tasks, you could set reminders, you could drop pictures and links in there. We use that for pipeline management. We use it for like asset management, writing down lists and assigning who's doing what, setting dates that things are due. So it's been a good like productivity tool that we use actively, but I think we should use it even more actively than we do. And it's free.
Yeah, I've honestly never used that and never heard of it. So that's cool. I'll have to take a look at it for sure, because I use Excel, but I heard some statistic a long time ago. It's like there's only like 2 to 5% of the people in population actually know how to like use all the tools and the features of Excel, and everybody else is just like just roaming the the Excel.
Yeah.
Okay. What about a book that's helped you with your business and real estate?
So I liked one of the early books that I read it was more motivational, I would say, than like call it technical. Powerhouse Principles, which was a biography of co-founder of Related. He basically created the Miami branch of Related Companies.
Okay.
And he really built up from absolutely nothing. He was an immigrant that really had very little money, and he started putting together deals, and he tells a bunch of deal stories. It's I don't know, it's still a few hundred pages, but it's an easy read, and it's there's no sale behind it like a lot of these books. So I like that one, and I often suggest that book.
Yeah, I'll have to take. I haven't heard of that one.
Just Jorge Perez is the who it's about.
Okay, yeah, I'll take a look at that too. Those are good pieces. Okay, and is there anything that I didn't ask you that you want to add in here, especially about your business or anything else?
No. I mean, I try to. We try to remain pretty approachable. I did start in this business when I was really young. I like being a resource to young people in real estate. So I encourage you to reach out. I'm happy to take some time at some point. I'm extremely busy right now, but generally I'm happy to carve out 15, 20 minutes and talk to anyone, regardless of your level of real estate investment or desire or where you are today. We hope to be doing this for a very long time, and always happy to connect.
Yeah, that's awesome. And then where can people reach out to? What's the best way?
Best way is through our website, DXEProperties.com. You could contact us, or we have a scheduler on there where you could directly set some time on our calendars with one of us.
Okay, sweet. We'll put that website also in the show notes so everybody can see it and they can go directly to it. Well, Josh, dude, this has been super enlightening, especially, you being in a completely different market. So it was awesome to chat with you, and also, get a little bit of information on what you guys do and how you guys are, still winning in this market, which is a super competitive market.
Thank you. This was great. It was good chatting.
Yeah, man. Well, thank you so much, and we'll talk to you soon.
Thank you.